Welcome to the new frontier of investing, the space economy. It's a sector where colossal ambition meets cutting-edge technology, a thrilling intersection of national defense, global infrastructure, and deep space exploration. The stakes here are astronomical. Fortunes can be made on a single successful contract or groundbreaking innovation. But the financial volatility and execution risks are just as immense. It's a high-wire act without a knight. Today, we're looking at two compelling players in this arena, Redwire Corporation and Voyager Technologies. Both are mid-sized firms aiming to carve out a significant piece of this burgeoning market. They share a focus on space infrastructure and defense, but they're taking different paths. Redwire is building a name for itself in advanced aerospace solutions and autonomous systems, with operations spanning the US and Europe. Meanwhile, Voyager specializes in protective tech, focusing on missile defense and national security, with a footprint across the US, Europe, and the Middle East. Both companies promise incredible rewards for those willing to brave the risks. So let's dive in and see which of these space pioneers might be better positioned for the journey ahead. First up is Redwire Corporation, trading under the ticker RDW. Redwire presents itself as an integrated space and defense tech company, providing a versatile suite of advanced solutions. The optimistic view, the bull case for Redwire, is built on a foundation of powerful growth drivers. The company boasts a contracted backlog of over $355 million, with a healthy book-to-bill ratio of 1.25, suggesting a steady stream of future revenue. They've landed high-profile awards that showcase their technology edge, like a $44 million contract from DARPA for the Otter mission, which aims to develop the world's first air-breathing spacecraft. This isn't just a distant dream. They're expanding production with a new 85,000 square foot facility in Michigan and another in Albuquerque to support space and missile defense work. The recent acquisition of Edge Autonomy is already paying dividends, contributing nearly $50 million to third-quarter revenue and diversifying their business between space and defense. Management is optimistic, projecting future gross margins in the 27 to 30% range and highlighting a massive $10 billion pipeline of potential opportunities. But here's the other side of the orbit. The bear case for Redwire is impossible to ignore, and it centers on profitability, or the lack thereof. Despite a 50% year-over-year revenue jump in the third quarter, the company's financial shortfalls are expanding. Net loss nearly doubled to $41 million compared to the same period last year. Their earnings per share came in a staggering 141% below what analysts had forecasted. The stock has been highly volatile, taking a nearly 60% hit over the last 6 months. Analysts have taken note, with firms like Bank of America citing challenges with integrating the Edge Autonomy acquisition and cutting their price target. The company itself had to narrow its revenue guidance for the year, pointing to delays from the US government shutdown. These aren't just teething problems, they're significant execution challenges, including $8 million in unfavorable cost adjustments on projects, which raises serious questions about their ability to manage costs and deliver on their promises. Now, let's turn our attention to Voyager Technologies, ticker VOYG. Voyager is positioned as a specialist in protective and exploratory space technology, focusing heavily on missile defense systems and national security. The bull case for Voyager is anchored by something every investor loves to see: financial stability. The company has what can only be described as a fortress balance sheet, holding over $413 million in cash, carrying zero debt, and having access to an additional $200 million credit facility. This gives them immense flexibility to weather storms and fund growth. They've been making strategic moves, acquiring companies like Estes Energetics to bolster domestic propulsion capabilities, a critical component for defense systems. Analyst support is robust, with firms like JP Morgan and Bank of America issuing buy ratings and setting price targets that suggest more than double the current stock price. The excitement is largely built around two key programs: their involvement in the next-generation interceptor for missile defense and the development of the Starlab commercial space station. Starlab is a massive undertaking that is steadily hitting its development milestones with NASA, and management projects it could one day generate over $4 billion in annual revenue. However, just like Redwire, Voyager has its own set of significant challenges. The bear case is rooted in its persistent unprofitability and a brutal market slump. The stock has plummeted over 60% in the past year. While its third-quarter adjusted earnings per share loss was an improvement over the prior year, it still missed analyst expectations, and the adjusted EBITDA loss actually widened. Revenue has been flat. This performance has prompted some analysts to turn cautious, with Morgan Stanley, for instance, slashing its price target while maintaining a neutral rating. The company's valuation is high for a business that isn't yet profitable, and multiple analysts have recently revised their earnings forecasts downward. There's a clear dependence on a few massive, long-term government contracts, which introduces a concentration risk if programs like Starlab or the Interceptor face delays or funding cuts. So, how do these two stack up head-to-head? In the high-risk, high-reward context of the space economy, they represent two different flavors of the same bet. When we look at growth, Redwire's revenue is surging due to acquisitions, while Voyager sales have been flatter. But on financial health, Voyager is the undisputed leader with its massive cash pile and no debt, a stark contrast to Redwire's moderate debt and ongoing cash burn. Market performance for both has been extremely volatile, reflecting broad investor uncertainty in the sector. However, analyst enthusiasm appears slightly warmer for Voyager, drawn by its financial prudence and the sheer scale of the Starlab project. When we look at their future outlooks, a fascinating parallel emerges. Both companies have enormous potential pipelines and are developing truly transformative technology. Redwire is pushing the boundaries in very low Earth orbit, while Voyager is building the next generation of space stations and missile defense. Yet they share the same fundamental hurdle, proving they can turn that innovation into consistent profit. They both exemplify the sector's incredible promise, tempered by very real execution challenges and sensitivity to government budgets. So what's the takeaway for an investor? Both Redwire and Voyager offer compelling exposure to the transformative potential of the space economy. These are not your stable blue-chip stocks. They are aggressive bets on the future of defense, infrastructure, and exploration. They embody the sector's incredible allure, but they demand a high tolerance for risk. The ongoing financial losses and stock volatility are not for the faint of heart. These companies require patience and a strong belief in their long-term vision. As always, the final frontier of investing begins with your own research. Dig deeper, understand the risks, and decide if you're ready to launch.